Hello and welcome to MarketSquare, your go-to show for deep insights into business and economic trends. I'm Olaiton Adebayo, and today we're diving into key development across Nigeria. Stay with us as we break it all down. Welcome back to Market Square. President Bola Ahmed Tinubu has set an ambitious target of 7% annual economic growth, a goal he says is key to lifting the country out of its financial difficulties. But the latest figures show that economy expanded by just 3.13% in the first quarter, growth that was helped by rebasing of the gross domestic product, which put the GDP size at $243.55 billion. While presenting the figures to his cabinet, the president said reforms put in place have strengthened macroeconomic stability and improved investor confidence. But he admitted that low public savings continue to weigh on growth. Beyond the numbers, economic pressures are still mounting. Nigeria continues to grapple with insecurity in the northern region, while the economy, once ranked as Africa's largest, is now projected by the International Monetary Fund to slip to the fourth place this year. The reform agenda is centered on removing costly fuel subsidies and devaluing the currency to stabilize the exchange rate. The measures were intended to reduce fiscal pressures and encourage investment. However, the ripple effect has been sharp. Prices across the board has climbed, while support programs to ease the burden on households and businesses have been slowed to take off. The concern now is whether the government can strike a balance between stabilizing the economy and delivering growth at a scale that truly improves living standard. While the government is setting ambitious growth targets, the reality on the ground shows a more cautious picture. Latest inflation figures suggest some relief, but also underline the pressures that still weigh on households. Nigeria's latest inflation report for July 2025 paints a picture of cautious optimism mixed with persistent risks. According to the National Bureau of Statistics, headline inflation is for the fourth consecutive month, dropping from 22.22% in June to 21.88% in July. At first glance, this decline suggests some relief in the battle against surging prices, but the underlying details reveal a more complicated reality. The numbers show that while overall inflation and core inflation trended slightly downward, food prices continue to resist meaningfully easing. Month-on-month food inflation moderated a little, falling from 3.25% to 3.12%. Yes, the year-on-year figure actually rose from 21.97% to 22.7%. For ordinary Nigerians, this means that the cost of food, the single largest component of household spending, remains stubbornly high. Adding to the concern, month-on-month headline inflation climbed from 1.68 to 1.99%, indicating the price increases are still accelerating in the short term, despite broader slowdown. The improvement in headline figures has been driven partly by relative exchange rate stability, improved investor confidence, and government interventions, such as import duty waivers on essential staples like rice and maize. A base effect measured against last year's historical high levels has also contributed to the softer readings. Together, these factors create the sense of stabilizing macroeconomic environment. However, the relief is uneven. Urban inflation slowed to 22.01% compared to last year levels, while rural inflation stood at 21.08%. More worrying is the fact that rural month-on-month inflation spiked sharply to 2.30%, up from just 0.6% in June. This suggests that communities outside major cities already grappling with insecurity, poor logistics, and climate disruptions are bearing the brunt of rising pressures. The impact of these numbers is twofold. For households, the slight easing of inflation is not enough to offset the persistent strain of high food costs. Many families still find that their purchasing power is shrinking, with wages unable to keep up with the rising cost of essentials. For businesses, high borrowing costs continue to choke investment and expansion, while inefficiency in transportations and insecurity across farming zones keep input costs elevated. From a policy perspective, the challenges is clear. While monetary tightening has slowed inflation, it cannot by itself solve the structural issues driving persistent price hikes. Fiscal discipline, investment in infrastructure, and deeper reforms in agriculture and energy are essential if the country hopes to turn this fragile progress into lasting stability. In the end, the July report signals progress but not victory. The headline numbers may look encouraging, but for millions of Nigerians, the reality of high food prices and rising monthly costs keeps the cost of living crisis alive. The real test will be whether policymakers can build on this fragile relief and create conditions for sustainable economic stability. In the financial space, attention shifts to Central Bank of Nigeria, which has reaffirmed its commitment to sustaining consumer protection initiatives across the sector. The Central Bank of Nigeria has renewed its commitment to sustaining initiatives that safeguard consumer interests in the financial sector. At a recent fair, team driving alternative payment channels as tools for economic development. The Apex Bank emphasized that its role goes beyond regulation. It's also about protecting the everyday consumer in an increasingly digital economy. The fair served as a platform for dialogue with stakeholders across fintech, microfinance institutions, micro, small, and medium enterprises, regulators, and academia. The bank stressed that tools for financial inclusion and economic growth remain central to its strategy, particularly in linking small and medium enterprises to wider opportunities that can stimulate productivity, job creation, and price stability. According to the institution, recent improvements in foreign investments inflows, positive trade balances, and rising financial inclusion rates shows progress in its efforts to stabilize the economy. Yet, challenges remain. Stakeholders note that micro, small, and medium enterprises, often described as the lifeblood of Nigeria's economy, are struggling. The legacy of past monetary policies, such as the Naira redesign and cashless transition, left many microfinance banks weakened, cutting off grassroots communities from access to finance. Participants at the fair emphasized that for Nigeria's economy to thrive, policies must be intentional about supporting small businesses. They argued that just as micro, small, and medium enterprises are critical to driving economic growth in advanced economies, they are equally vital in Nigeria, serving as the largest employers of labor and enablers of community wealth. Financial inclusion cannot be achieved in isolation. It requires deliberate government policies, resilient infrastructure, and consistent support for microfinance institutions. Without this, the gains of consumer protection and alternative payment channels may not translate into broad-based economic growth. The Central Bank of Nigeria assurance is timely, but sustaining trust in the financial sector will depend on how these consumer-focused initiatives are matched with structural reforms that strengthen small and medium enterprises and expand access to finance. In a fragile economy, consumer protection is not just a safeguard, it's a growth strategy. On the industrial front, the pressure from a weakening currency is forcing Nigerian factories to look inward, turning to local sources as a survival strategy. Nigeria's manufacturing sector is undergoing a painful but necessary transformation. For decades, many manufacturers depend heavily on imports of raw materials, settling invoices in scarce US dollars. But with a naira sharp devaluation and a prolonged shortage of foreign exchange, this model has become unsustainable. The central bank's decision to float the naira, part of sweeping economic reform, unleashed volatility that left firms scrambling. More than 800 companies shut down last year under the pressure from rising input costs, while multinationals scaled back or exited the market entirely. For those that remain, survival meant a rethink of business models and supply chains. The crisis has accelerated a trend towards local sourcing. Companies like paint and gas manufacturers are increasingly relying on domestic suppliers, reducing their dependence on imports and cutting exposure to currency shocks. Industry data shows that local materials used in manufacturing rose to 57.1% in 2024, a 5-point jump in just a year. For some firms, that shift has translated into significant cost savings and allowed them to avoid passing steep prices hikes onto consumers. But for those that are still in business, the crisis has triggered a major shift. Many companies are now sourcing locally to cut costs and reduce dependence on forex. Some firms say these reforms were a wake-up call. By partnering with local suppliers, they have managed to stay afloat, even if this transition has not been without headaches, such as infrastructure gaps and inconsistent supply. Still, some see this as a chance to build resilience and lower costs in the long term. For now, what is clear is that Nigerian manufacturers are adapting. Whether this forced shift becomes a lasting foundation for a resilient industrial future will depend on how both industry players and policymakers navigate the path ahead. The push for growth, a slowdown in inflation, renewed focus on consumer protection, and a shift by factories to local sources all highlight the direction of Nigeria's economy. Policymakers and businesses alike continue to navigate the challenges as the country works towards stability. That's it for today on MarketSquare. I'm Olaitan Adebayo. Thank you for joining me. See you on the next one.